Good morning, everyone. Welcome to another episode of the Mizuho Week Ahead. I'm Jingwen, market economist at Mizuho Bank. This week's theme is buying time amid compounding stress. Risk sentiments softened last week as elevated US-Iran tensions, AI-related credit jitters, and rising long-end yields weighed on markets. US equities retreated from record high, while Brent crude extended its advance towards US $92 per barrel. US Treasury Secretary Scott Bessent announced upsized long-end Treasury buybacks after the 30-year yield climbed to its highest level since 2007. Inflation concerns and increased long-end supply driven by hyperscalers financing AI-related capex kept upward pressure on yields. While Bessent signaled scope for larger buybacks and greater fiscal discipline, investors remain skeptical as US public debt crossed US $40 trillion as reflected by the market's response, which was short-lived, with views reversing the decline the following day even as the dollar remained soft. While the July FOMC meeting minutes showed many participants would support a rate hike if inflation proved persistent, the absence of stronger committee support for an imminent hike and softer economic data since the meeting tempered market expectations for near-term tightening. That said, stronger than expected US services data and hawkish Fed commentary last Friday backstopped bets for potential Fed rate hikes, and UST yields continued to rise. Geopolitical risks continued to escalate after President Trump ruled out extending the June US-Iran MOU, ending the window for negotiations. The US is planning to increase economic pressure on Iran and with secondary sanctions as an additional tool, although the effectiveness of additional sanctions remain uncertain after decades of existing restrictions. The UAE's decision to sever economic ties could prove more damaging given its role as a major Iranian trading partner. In Asia, China's July activity data disappointed, underscoring a two-speed economy where strength in high-tech manufacturing and bond financing contrasts with weak domestic demand, investment, and lending. A flatter CGP yield curve reflected with surfacing deflation concerns, while expectations remain on targeted liquidity support rather than broad-based monetary easing. In Southeast Asia, Bank Indonesia remained on hold as expected and signaled reluctance to allow SRBI yields to rise further, suggesting borrowing cost concerns are beginning to outweigh FX defense. Thailand's Q2 GDP surprised on the upside, supported by exports despite softer consumption. Looking ahead, attention will turn to the Jackson Hole Symposium to see how Fed Chair Kevin Warsh intends to restore credibility in bringing down inflation. Bessent will also provide further details on economic measures targeting Iran on Monday. Across Asia, central banks are broadly expected to remain on hold, but for different reasons. The BOK is likely to assess the impact of its recent hike while retaining a hawkish bias, while BOT and BSP have to balance sticky inflation amid softer growth outlooks. All in, a gathering storm of rising bond yields, elevated geopolitical tensions, softer data, and AI-related credit jitters is likely to pose an enduring threat to risk sentiment. Amid this backdrop, policymakers have little choice but to buy time, remaining on hold while waiting for greater clarity. For more information, please refer to our Week Ahead publication or contact your respective sales desks and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you.